Hi. So, welcome. Now we're going to talk about this is a follow-on to the stock market. What's a stock? What's a market? And want to talk about how the stock market is regulated, the Securities and Exchange Commission, where it came from, what its function is, and why it's good for us as investors. So let's start with this. And yeah, it's the big things are transparency, oversight, and the rules that it sets for the public markets. So, why regulators matter? Well, before 1929, there were no stock regulations, and after that stock market crash in October 1929, that's when we decided we really need a government oversight group to make sure that there's investor confidence, basically, that the markets aren't rigged and that they're transparent and they're fair. That's really the key, you know. And stock market has been the greatest wealth generator of the past century. It's really the surest path for any of us to save, invest, and stay in. And so what the regulators do is they provide transparency. Investors need accurate information to make rational decisions, and that's what the annual reports with audited financials give us. Fairness, rules to prevent insider trading and insiders from exploiting an information asymmetry, basically information other people don't have. And investor confidence. Markets only work if the participants trust the system. And that's really, investor confidence is job number one for the Securities and Exchange Commission, which is a great thing for us to have, regulated markets. So this is why it was invented. After the 1929 crash, the crash wiped out millions of investors and triggered the Great Depression. The worst economic collapse in U.S. history, and then it became that contaminated. There was a worldwide depression in the 1930s, and it's two acts. There's the Securities Act of 1933, and that requires the companies to register their securities and disclose material information before selling to the public. And then the 1934, the 34 Act, and that governs the secondary market right after they're trading, the trading, broker dealers, and the reporting requirements and ongo, the 10Ks, 10Qs, which I'm going to talk about here next. Yeah. So the 10K is the big one. That's our major one. That's fully audited financials. That's once a year, right? An annual report. And the MD&A section, the management's discussion analysis, very good. And you can find these all for any public company on the SEC website, sec.gov. Risk factors they have to talk about, business overview, executive compensation and disclosures, and other things like if they're involved in lawsuits, all kinds of stuff. And it has to be filed within 90 days of the fiscal year end. And then the 10Qs are updating the 10K for 3 quarters after that, right? And they update things so that every quarter there's a Q. And then there's also an investor call after that with the CEO and CFO usually. And 8Ks are for material events, things that happen. If there's a merger, acquisition, something, or changes in the upper management, CEO or CFO, major contracts or agreements, if you change accountants and things, all those things have to be filed very quickly after they happen, so that investors know what's going on. Um, so what happened basically, and it's been in the early 2000s, 2002, there were some accounting scandals, and so the Congress made a new law to try to limit some of the loopholes and make the reporting more accurate. There were companies, Enron hid billions in debt in off balance sheet financings, and the CFO really enriched himself via these things called special purpose entities, and this whole giant energy company collapsed, and all of the employees, and they had their, think about them, they had their pensions in that stock, and all the shareholders, it was just a disaster. Arthur Anderson was the premier accounting firm. They were Enron's auditors, and they participated in the cover up, the shredded documents, and they were destroyed. That was the end of that accounting firm, one of the greatest. WorldCom is another big fraud of that time. And so when these frauds were happening, they were, how could we prevent these frauds from going forward. And that's basically what the Sarbanes-Oxley Act, SOX, was intended to do. And that was in 2002. And now CEOs and CFOs must personally certify, that the statements are accurate. The independent audit committees are required, and auditors are prohibited from providing consulting services to the auditing clients. That's what happened. That split all of these big accounting firms into they had an auditing part, and then they had a big consulting division that started to develop because they would cater to their auditing clients. Well, they thought that gave a lot of conflict of interest, so those companies had to disband, and the auditing firms had to be separate from the consulting firms. Um, it was quite a time, really interesting. Um, so what the foundation of um, the financial reporting that gets done is the bookkeeping, and the bookkeeping is journal entries and the general ledger, and they use software to do this kind of accounting, and a separation of duties so there's no fraud. Nobody does, somebody opens the mail, somebody enters the transactions, somebody cuts the checks, all different people. So it's really separation of duties is a critical fraud prevention, and you have to report on that as a company. So the basis is bookkeeping, and then accounting turns that bookkeeping into financial statements, and the financial statements are what we read in the 10K and the 10Qs. Um, and they're audited financial statements in the 10K. It means a outside accounting firm comes in and makes sure that yes, these financial statements are done in accordance with generally accepted accounting principles, what they call GAAP, and so they're relatively they're accurate. And there's three financial statements. There's the income statement, the balance sheet, and the cash flow statement. And we'll talk about more about those in the future, because then we can really read the 10Ks and get our information from there. And that's where we should to make really um, wise investing decisions. So the auditors are the independent check, right? They opine on the financial statement preparation. They don't prepare them, but they give their opinion. Yes, these were conducted properly, and they comply with GAAP, and they assess the reasonableness. There's a lot of assumptions that go into these, and the reasonableness of the management's assumptions, and they apply materiality thresholds. Not every error. If it's just a small amount, it has to be material to be considered an error that has to be redone or something. And they test the accounts and receipts and make sure everything's up to snuff. And then there's two oversight boards from there. The generally accepted accounting principles are the rule book, for financial statements in the U.S. And FASB is a financial accounting standards board. It's an independent private body that sets the principles that are in GAAP. So those are important organizations. So, there's valuations too that get done. If there's options if there's embedded derivatives, if you have convertible debt, things like that, if you have options outstanding, these kind of things have to be valued, and they get pretty complicated to value, because that has to go into the financial statements. Marketable securities have to be what they call marked to market, whatever the market price is at that time. Those securities have to be valued at that price. So there's a lot that goes into these financial statements that we need to know about. Now, we can find all of these 10Ks and 8Ks and 10Qs on the SEC website under the EDGAR filing, and that stands for Electronic Data Gathering, Analysis, and Retrieval. And it was basically done in the pre-web era. The SEC developed this system in 1996 and digitized all of their files when the internet was new, but before websites where HTML came up. So just before that, and they spent a whole bunch of money doing it, but it's really a great thing. So if you go on the sec.gov and click on the EDGAR button, and then you can type in any company that by their trading symbol or by their name, and look at their documents. And before that time, you had to go to the library or to your brokerage office and look in these giant telephone book size. Yeah, people don't even know what a telephone book is anymore, right? But big, printed documents that and look up the 10K for a particular company. What a time consuming pain in the neck. Now you can just go online and check them out. So it's really become much more convenient as a shareholder. The cost of doing all this for a company is about $1 million a year. 250 would be very low, but some companies, can do it that low. And that's audit fees, legal compliance, Sarbanes-Oxley compliance, investor relations, all those kind of things factor into that. Um, the trick is that you have competitive disclosures. That's why a lot of companies remaining private these days, because then they don't have to disclose all this information that could reveal your strategy to another competitor. And private companies don't have to share that information. Plus, they don't have all that cost. So there's incentives to be a private company. Public gives you the liquidity and more investors and a price discovery mechanism, as we talked about earlier. So the reporting system is the trust system. Investors have to be confident that the financial markets and the companies are reporting are really what they say they're going to do and not defrauding them as investors. That's why we can invest with confidence. So it's the disclosure of the public companies. They must share with investors to make informed decisions. Key verification with independent auditors that things have been done properly, and accurately following GAAP, and enforcement. If there's SEC policy violations, fraud has criminal consequences post Sarbanes-Oxley. So, without financial reporting, the public markets, these robust, deep financial markets, really couldn't exist. So it's really another sort of technical innovation that allows for us to have the economic development engine of well-funded companies and ability to allocate capital to the best possible projects. So very cool. So that's it for this one, and I'll catch you in the next video.